Yes, people, good morning, good afternoon, good evening to all South India students. How are you? Hope so you are good. I am also good. Good evening to all of you. Yes, people, good evening to all of you. So here in the volume number 3, that is the last volume, we were discussing about some concept. So let's complete this concept first. Yeah, good evening, Nehal. Good evening, Shiva. Good evening to all of you. Yes, people. So let's discuss to last concept of this volume and then we'll move to the another volume. Okay guys, so first is there is a one section, that section number is 170A, and 170A is basically effect of the order of tribunal or court in respect of business reorganization. Now what do you mean by business reorganization? So basically business reorganization means you can say that the amalgamation or demerger is called your business reorganization. I can take an example. For an example guys, there was one company, name was Vodafone, and another company, name was Idea. Now Vodafone and Idea. Now suppose this Vodafone and Idea, they both merge and they made one new company in the name of Vodafone Idea Limited, or I can say that the VI. So they made one new company, that is the VI Limited. This is called your amalgamation. Now guys, what happened? Suppose Vodafone and Idea, this both the companies merge and they made one new company, name is the VI. And suppose they merge with effect from assessment with effect from 1st April 2021. Suppose they merge with effect from 1st April 2021 means previous year 21-22. But guys, what happened? You know that in case of the merger, many time like court or NCLT, they pass the order, and in that passing the order of the merger, they sanctioning the scheme of the merger, it is a time consuming process. Many times it's happened that order of the court or NCLT come after 1 year, 2 year, 3 year also, and after that they will approve your amalgamation plan or reorganization plan. So guys, what happened here for the previous year 21-22, this merger is applicable from 1st April 2021. So for the previous year 21-22 onwards. Now guys, what happened for the 21-22, can I say that Vodafone Idea will file the return on 31st October 2022. So on the 31st October 2022, this is your ROI due date, return of income due date, and ROI due date was 31st October 2022. So on 31st October 2022, here like VI Limited, Vodafone Idea Limited has already filed the return. On 31st October 2022, VI filed the return. But guys, suppose this amalgamation scheme was approved only on 19 Feb 2023. Suppose this amalgamation scheme is approved by the court or NCLT on the 19 Feb 2023. On the 19 Feb 2023, when this scheme is approved, but before that they already filed the return for this year. But earlier return was filed, obviously that was without taking the benefit of brought forward losses and unabsorbed depreciation of the amalgamating company. Because normally in case of amalgamation, you know that whatever amalgamating company losses or unabsorbed depreciation, then that can be carried forward and set off by the amalgamated company. But guys, here when they filed the return for the first year, that time amalgamation was not approved till that date. So they have filed the return in the normal course. They have not considered the amalgamation scheme. It means they have not taken the brought forward losses or unabsorbed depreciation of the earlier company. Now guys, after approving the scheme, now for this particular year, they have to file the modified return. They have to file the modified return, and according to the scheme of the amalgamation, now they will able to claim the losses and unabsorbed depreciation of the old company as per the amalgamation scheme. So guys, what this particular section says, that try to understand. This section says that in case of the business reorganization, where prior to the date of order of High Court, means prior to the date of order of High Court or a tribunal or an adjudicating authority under IBC 2016. So prior to the date of order of a High Court or a tribunal or a adjudicating authority under IBC 2016, as the case may be, a return of income has been furnished by the successor under section 139 for any assessment year relevant to the previous year to which such order apply. Such successor shall furnish within a period of 6 months from the end of the month in which order was issued. So within the 6 months from the end of the month in which order was issued, a modified return in the ITRA electronically as per the order. Now guys, for that year, suppose you file the modified return and suppose assessment is already completed, then AO will do the reassessment of that year according to that modified return. But suppose assessment is pending, then AO will complete the assessment as per the modified return. So here, assessment on the basis of modified return. If assessment is already completed, then AO has to pass an order modifying the assessment or reassessment proceeding as per the modified return. So AO has to pass a modifying the assessment or reassessment proceeding as per the modified return. And guys, if assessment is pending, then AO has to process to complete the assessment or reassessment proceeding as per the modified return. Now, business reorganization means amalgamation or demerger or merger of business of one or more person. That is called your business reorganization. Now, here one example I have took. Suppose A Limited merged with the B Limited with effect from 1st April 2022 via the order of High Court on the 1 November 2023. So High Court order came on the 1st November 2023, but before that, obviously B Limited has already filed the return. And B Limited has already filed the return of income for the assessment year 23-24 on the 31st October 2023. Then B Limited has to file the modified return for the assessment year 23-24 in accordance with the limited of order of the High Court on or before 31st May 2024. That is 6 months from the end of the month in which order has came. So here guys, order, High Court order is came on the 1st November 2023. So after November, this is December, Jan, Feb, March, April and May. So till 31st May 2024, they will file the modified return. You got my point or not? Yes. Now guys, there is a one last section. That section is a section number 89A. Now there is a one relief. What is this section 89A? All people pay attention. So here, section 89A is related to some relief, or you can say that rebate, relief or rebate. Here rebate under section 89A. Now guys, this rebate is applicable for a specific person. All people pay attention. I can take one example, and from the help of that example, we will able to understand this section. Guys, suppose for an example, there was a one person, name is Mr. Raj, and Raj was working, means he was doing the job in USA. So he was working in USA from previous year, or from suppose 1st April 2005. From 1st April 2005, he was working in USA in one company. Now guys, suppose he retired. He retired from USA. He retired from job and he shifted to India, settled in India on 16 April 2022. On this date, he settled in India. Now guys, in the previous year 22-23, previous year 23-24, his residential status is, that person is basically resident and ordinarily resident. That person is resident and ordinarily resident in India. Earlier he was in USA, he was doing job in USA, he was working in USA. But guys, he shifted to India, and now he is a resident and ordinarily resident in previous year 22-23 as well as previous year 23-24. Now guys, when he was working in USA, that time he has opened one account there. That is account in relation to the retirement benefit. So account in relation to retirement benefits. Retirement benefits means, suppose there is a PF account, provident fund account, or any type of the other account that is related to the retirement benefit. Now guys, what happened? In the USA, in the UK and in the Canada, in the three countries, that is Canada, USA and UK, in the three countries, what happened? There are some specified retirement benefit account like RPF and all, PF and all. So if any income is from that account, then that is not taxable on the accrual basis. Means if any income is from the PF account and all, that is not taxable on accrual basis. Means that is not taxable on accrual basis. It is not taxable on accrual basis in that particular country. But guys, it is going to be taxable. It is going to be taxable on receipt basis. It is going to be taxable on receipt basis. It is not going to be taxable on the accrual basis. So every year when interest accrued, interest or whatever income is accrued, that time it is not taxable. It is going to be taxable on the receipt basis. Means whenever you will withdraw that amount from that account, only that time it is going to be taxable. Now guys, when that person in the previous year 22-23 or previous year 23-24, that person is resident and ordinarily resident. So obviously whole world income should be taxable in India. Whole world income, whatever income he has earned in the Canada or UK or US, wherever he is getting the income, that should be taxable. And Indian law says that it should be taxable on the accrual basis. Like salary income is normally taxable on the accrual or receipt, whichever is earlier. So accrual basis, it should be taxable. But guys, there is a one section, we have introduced the section 89A. And 89A says that, suppose that person earlier was non-resident, he was doing the job in the USA, Canada or UK. Now he became the resident, and guys, in the UK, USA, Canada, he is having some account, and in that account, whatever income he is getting, that is taxable on the receipt basis. Then don't worry, in India also you have an option. You have an option either if you wish to pay the tax in this year. Suppose for an example, in this year, he is getting the $40,000 income. $40,000 income. This is on the accrual basis. So you have the option, means either on this $40,000 and this $40,000 you can pay the tax in this particular year only, or guys, in India also it is optional. As per rebate 89A says that you can pay the taxes at the time of the withdrawal. So in India also, on this income there is no need to pay the tax now. On this income, you can pay the tax only in the year in which it is taxable in the, like that foreign country. So at the time of withdrawal only, you can pay the taxes. At the time of the, like, income is accrued, that time there is no need to pay the tax. When income is accrued, that time there is no need to pay the tax. Whenever you will withdraw that amount, whenever you will get that money, only that time you are required to pay the tax. Only that time you are required to pay the tax. You got my point or not? Yes. Now guys, suppose for an example, assessee exercise this option. So on this $40,000, now it is not taxable in this year. It is also not taxable in this year. Suppose next year 24-25, he is a resident and ordinarily resident. That time also this 40,000 is not taxable. Suppose every year he is getting the accrual, the income is $40,000. So at the time of accrual, it is not taxable. Now suppose in the previous year 25-26, he withdraw the money. So when he withdraw the money, that time it is taxable in the foreign country, same time it will be taxable in India. So when it is taxable in the foreign country, at the same time it is getting taxable in India, same time it is going to be taxable in India. So guys, when this particular income is taxable in the foreign country, that time only it will be taxable in India. But guys, this option is applicable only when that person is a resident person. So if any person is resident person, now he's a resident person, he can exercise this option and he can say that I will pay the tax on this retirement benefit only in the year in which the money is received, or I withdraw the amount from that particular account. So whenever he will withdraw, only that time it is going to be taxable. But suppose guys, what happened? You know that. Suppose in the previous year 25-26, in the next year, that person became the non-resident. Still that person has not withdrawn the money, but that person became non-resident. Now guys, if that person became the non-resident, if that person became the non-resident, now he became the non-resident. So in this year, whatever income from the foreign account, obviously that is not taxable. But what about, sir, this earlier, like 3 years, he has not paid the taxes. So lawmaker says that on the whatever income, this 40,000, 40,000, 40,000, 1,20,000 dollar, he has not paid the taxes. Now, when he became the non-resident, then this 1,20,000 is going to be taxable in the previous year 24-25. Means in the last year, when he became the non-resident, obviously this year he will not pay the taxes, he will not file the return. But guys, this $1,20,000 is going to be taxable in the previous year 24-25, that is the last year. But sir, on this particular income, till what time he has to pay the tax? So guys, he has to pay the taxes. Who he has to pay the taxes on $1,20,000 up to the due date of return filing of previous year 25-26. And 25-26 return filing due date will be 31st July 2026 or 31st October 2026. So what I am saying that here $1,20,000, here $1,20,000, here $1,20,000, here $1,20,000 is going to be taxable in previous year 24-25 only. But you have to pay the taxes up to the due date of return filing of this particular year. So guys, here we are going to start with this concept. Pay attention what this concept says. Relief from taxation in income from retirement benefit account maintained in the notified country. So here was a specified person. Now what do you mean by the specified person? Here, pay attention. A person resident in India, means now he is a resident in India, who open a specified account in the notified country while being the non-resident. He was the non-resident and resident in that country. That time he has opened one account in foreign country. That person is called a specified person. Now what do you mean by the specified account? So guys, here an account maintained in the notified country. Notified country is only Canada, USA and UK. By specified person in respect of his retirement benefit, and the income from such account is not taxable on the accrual basis, but is taxable by such country at the time of withdrawal or redemption. That is called your specified account. So here, a specified person has income accrued in the specified account. Such income shall be taxable in such a manner in the year as may be prescribed. So here what they have prescribed, that I will explain you. Here all people pay attention. So option to be exercised by the specified person. So here, where a specified person has income accrued in the specified account during previous year 21-22 or thereafter. It means guys, this section is applicable from previous year 21-22 only. Earlier this section was not there in the law. This is applicable from previous year 21-22. So here, where a specified person has an income accrued in the specified account during the previous year 21-22 and thereafter, then at the option of the specified person, means a specified person has the option, such income would be included in the total income of previous year, in which income from that specified account is taxed at the time of withdrawal or redemption. As the case may be, in the notified country, the option has to be exercised for all the specified account maintained by the specified person. And guys, which income is going to be taxable, like which income is when it will be taxable? It will be taxable in the year in which you have withdraw. So here next point says that exclusion from the total income of a specified person, means which income will not be taxable in India. So here, where the option has been exercised by the specified person, the total income of a specified person for the previous year in which income is taxable would not include the following income. Means this income will not be taxable. Which income will not be taxable? First is, has already been included in total income of such a specified person in any of the earlier previous year during which such income accrued and tax thereon has been paid under the act. Means for an example guys, suppose for an example, this particular amendment is applicable from the previous year 21-22. Suppose for an example, in previous year 19-20 there was an income and there was a $40,000 income from that specified account. So on this income he already paid the taxes, because that year there was no option. That year it was taxable on the accrual basis. Suppose he was a resident in India, so that income is already taxable on the accrual basis. So guys, if on this 40,000 he already paid the taxes on accrual basis in India, then at the time of withdrawal, obviously nothing, that amount is not taxable. At the time of withdrawal, that amount is not taxable. So what this point says, try to understand. Again read it. Exclusion from the total income of a specified person. So where the option has been exercised by a specified person, the total income of a specified person for the previous year in which income is taxable would not include the income which has already been included in the total income of such a specified person in the earlier previous year during which such income accrued and tax thereon has been paid under the act, or was not taxable in India in previous year during which such income accrued on account of such a specified person being non-resident or resident but not ordinarily resident during the previous year, or application of DTAA if any. So guys, either that income is already taxable earlier on accrual basis, then it will not be taxable on the receipt basis. And second is, for an example, in that year that person was non-resident, there may be possibility in previous year 17-18 also there was some income in that account. But guys, that year that person was non-resident, so anyway that income is not taxable in India in the year in which that person was non-resident. So that income you have to ignore. So here, was not taxable in India in previous year during which such income accrued on account of such a specified person being non-resident or R but NOR during that previous year, or application of DTAA if any. Now, foreign tax if any paid on such income would be ignored for the purpose of computation of foreign tax credit under rule number 128. So foreign tax if any paid on such income, by since that income is not taxable in India at all at the time of withdrawal, then obviously whatever foreign tax you have paid, that we will ignore now, because foreign tax credit you can take only if that income is taxable in foreign country as well as taxable in India. Now next part. Once options exercise cannot be withdrawn. So options has to be exercised in the form number 10EE electronically on or before the due date under section 139(1), and the options once exercised for the specified accounts in respect of previous year would apply for all subsequent previous year and cannot be subsequently withdrawn except in case where a specified person become non-resident in any subsequent previous year. So once this option is exercised, it has to be applicable for the subsequent year also. Now consequences when a specified person become non-resident in subsequent previous year, then what will happen? So in case the specified person after exercising option to pay the option for any previous year, say previous year 22-23, become the non-resident during any subsequent previous year, say 25-26, referred as the relevant previous year, then option exercise above would be deemed to have been never exercised with effect from the relevant previous year, that is from previous year 25-26 he became the non-resident. The income which was accrued in the specified account during the previous year beginning with the previous year in which option was exercised in current year previous year 22-23 till the previous year immediately preceding the relevant previous year, that is previous year 24-25, would be taxable during the previous year immediately preceding the relevant previous year, that is previous year 24-25 only. And the tax on such income has to be paid on or before the due date for furnishing the return of income for the relevant previous year, that is due date for previous year 25-26. Till that date you have to pay the taxes. So this particular concept is given in the module, not more relevant for your examination perspective, but this is one section. Okay, so this is the completion of your volume number 3rd. In volume number 3rd, nothing is pending. We have covered everything from the volume number 3rd. Now guys, in the volume number 1, there is some correction. So if you have the volume number 1, just check that. And just check the PGBP topic first. And in PGBP topic, there is one small correction. In the PGBP topic, just check the 43B section. Just check the 43B section in PGBP. And in PGBP section 43B, that is Mukhya Nale Kande, there was one section, interfering section. And you know that particular section provided the MSME definition. Okay, what was the micro enterprise and small enterprise? Now guys, earlier ICI has given some different definition that was as per the act, but after some time there was a notification, and due to that notification they have changed the micro enterprise and small enterprise definition. So this is the micro and small enterprise definition, that is the new definition. Earlier ICI also has given the different definition, but now they have changed it. So just this is the definition. So whatever we did in your book, whatever we did in our book, just change it. Okay, so I think in your book there may be a page number, may be a different. Okay, because this is another edition, not another edition, same edition, but just I merge all 3 books in the one book now. So here guys, just rectify this definition. In your book, what is the page number? I think if you have the volume 1, 2, 3, then whatever the page number, Just change this definition and just note down this part only, like from here till here. Just note down this part. And now definition is very simple. For the micro enterprise, investment in the plant and machinery equipment is up to 1 crore, should not be more than 1 crore, and turnover should be up to 5 crore. And for a small enterprise, there is a up to 10 crore, and like a small enterprise, investment in plant and machinery equipment up to 10 crore and turnover up to 50 crore. So now definition is quite simple. So just copy down this part. Just copy down this part. Done, people? Done. Now guys, after this, in the volume 1 only, I think there was a SEZ topic. SEZ topic, 10 AA section. 10 AA. So in the SEZ topic, there was one section 10 AA. MAT AMT SEZ topic. There was one section 10 AA, guys. And in the 10 AA, this page where section 10 AA is given, deduction under section 10 AA. So guys, on this particular page here, one line you have to write, like export turnover means the consideration in respect of export brought into India in convertible foreign exchange within the 6 months from the end of the previous year or time permitted by the RBI. Earlier it was written that time permitted by RBI only, but this time they made one amendment and they says that whatever amount received within the 6 months from the end of the previous year or time permitted by RBI. So just write that within 6 months from end of the previous year. Within 6 months from end of the previous year. Just write within 6 months from end of the previous year. I think in your book, page number 161. Yeah, just write. Done, people? Done? Yes, done, sir, done. Now guys, after this, there was one remaining concept in your math topic. Here, this was the concept. One amendment made by the Finance Act 2021. There may be difference in page number. So guys, there was one concept. Just check this concept here. All people, just check this concept. that is example. After example, there is an amendment made by the Finance Act 2021. Now guys, what is this concept? I will explain you with the help of one example and you will able to understand, don't worry. Guys, you know that in the transfer pricing we have discussed two concepts. One is the advance pricing agreement and one is the secondary adjustment. Advance pricing agreement means APA and one is the secondary adjustment. Secondary adjustment means like suppose for an example, you have not brought that money in India within the time limit, then it will be treated as deemed loan to your associate enterprise and every year income will be included. That is called your secondary adjustment. And one is the APA, advance pricing agreement. Now guys, what happened due to the APA or due to the secondary adjustment, many times what happened, your income is increase of the like preceding years. For an example, suppose in the previous year 23-24, AO made some adjustment and due to the APA or due to the secondary adjustment, your income of previous year 21-22 is increased. Means income of previous year 21-22 is increased. For an example, there is a 5 lakh income and that 5 lakh income of the previous year 21-22 is increased. Then guys, if you remember, then we have discussed that suppose if your income is increased due to the APA or due to the secondary adjustment, then if you remember little bit from the advance pricing agreement perspective, then you have to file the modified return of this year. Because this year return you already filed earlier. Now you have to file the modified return. And guys, in the modified return, your income will be increased. You have to pay the excess tax and all. That is you will do in the income tax. But guys, if you remember, then you know that in the Companies Act, we never change the account. In the Companies Act, we never change the account. Suppose for an example, if there is a prior period adjustment, then we will not change the Schedule 3 P&L and balance sheet because once it is finalized in the AGM, after that there is no need to the change. You cannot change it. Whatever effect you want to give, you have to give in the subsequent year. You have to give effect in the subsequent year because as per the Schedule 3 P&L, profit and loss account and balance sheet, you will not change it. You cannot change it under the Companies Act. Now guys, what will happen in the Companies Act? In the Income Tax Act, obviously you will give the effect of this 5 lakh income in the previous year 21-22 only. But guys, in the Companies Act, what will happen? You will include this 5 lakh income in the previous year 23-24. Means you will include this 5 lakh income in the current year P&L as per the Companies Act. Because in Companies Act, you cannot change the prior year profit and loss account. It is not possible. So in the current year, you will give the effect. In current year, you will change it. So guys, here what happened in the current year, suppose you have included this 5 lakhs. So in the current year, your book profit will be increased. Because in the Companies Act, when you included this income in the current year, then your book profit will be increased in current year, your MAT will increase. But guys, here there will be one rebate. Now, what do you mean by this rebate? Guys, here rebate is provided by one rule, that is rule number 10 RB. And what this rebate is, I will explain you this rebate with the help of one example. And from that example, you will be able to understand. Don't worry about that. Pay attention, guys. Pay attention. Now, guys, what happened? This is all about the Companies Act. Now, we are just discussing about the Companies Act because in MAT, book profit is always calculated as per the Companies Act P&L, that is Schedule 3 P&L. So, there is a one company, BB Private Limited. Suppose our book profit for the previous year 23-24 means current year book profit is a 90 lakh. Our current year book profit is a 90 lakh and guys, in the current year book profit, there is a 15 lakh income of the previous year 2021 that is included in current year due to the APA or secondary adjustment. So guys, in simple word, I can say that earlier your current year book profit was 75 lakh only. Now, past year income 15 lakh that is due to the APA or secondary adjustment. In the Companies Act, this 15 lakh is included in current year. So guys, can I say that in current year our book profit is increased to the 90 lakh? And on the 90 lakh, 15% is MAT rate, so 13 lakh 50,000 is MAT. And health and education cess is 4%, 54,000. So here your total MAT is applicable in the current year is a 14 lakh 4,000. But guys, from this 14 lakh 4,000, you will get one rebate as per rule number 10 RB. Now, what is this rebate? Rebate is very simple. Guys, this rebate says that just do one thing. Okay, first calculate the MAT of current year, including that past year income. Just calculate MAT of current year, excluding that past year income. So guys, first is MAT of the current year including past year income is your 14 lakh and 4,000. This we have calculated. So on the 90 lakh multiply by 15% plus 4% health and education says that is the 14 lakh 4,000. That is your current year. That is your current year MAT of the current year including past year income. And just reduce MAT of the current year excluding past year income. So excluding past year income means, guys, you can say that current year income is now 75 lakh. So 75 lakh multiply by 15%. So on calculator you can do that. 75 lakh multiply by 15%, it comes to the 11 lakh 25,000 plus 4%, it is a 11 lakh 70,000. So current year MAT excluding past year income. So that is 11 lakh 70,000. So guys, this is the just reduce A minus B. So 2 lakh 34,000. 2 lakh 34,000. In simple word, I can say that this much MAT is increase in current year due to that past year income. Because if past year income is not there, then my MAT liability was 1170, but there is a past year income included in current year. So my MAT is increased by 2 lakh 34,000. Now guys, just calculate the MAT of that year, means MAT of the year for which this income is belongs, that is previous year 2021. Suppose that year book profit earlier was 5 lakh losses. Earlier there was a 5 lakh losses. So now you have to calculate the MAT of that year including that year income or excluding that year income. So suppose this 15 lakh was taxable in that year only, that is previous year 2021, then what could be your MAT liability? So can I say that that year MAT, that year book profit was 5 lakh minus? So guys, if 15 lakh is included in that year, so that year book profit comes to the 10 lakh. So here MAT of the previous year 2021 including income due to the APPA. So here 15 lakh was income minus 5 lakh book profit was negative. So remaining is a 10 lakh book profit. So on 10 lakh 15% plus health and education says that is 1 lakh 56,000. And second is MAT of that year excluding past year income. So excluding past year income means that year there was a book loss. So there was no MAT at all. So here D minus C is a 1 lakh 56,000. So I can say that this much MAT you have not paid in that particular year due to that income was not taxable in that year. It is taxable in current year. So guys, now this difference between this two amount and difference between this two amount, just take the difference. So difference between this two amount and difference between this two amount. So here guys, difference is 2 lakh 34,000 here and 1 lakh 56,000 here. So in simple word, whatever difference between now this two amount will be your rebate as per the rule number 10 RB. So this is your rebate as per the rule number 10 RB. This is a one concept like a arrear salary. You know that in the intermediate, in the salary head, I think you must know about the arrear salary. And in the arrear salary, what happened? You know that in the like your intermediate, you heard about the arrear salary. Arrear salary means arrear salary is basically like suppose your earlier arrear salary taxable in current year. Then what happened? You know that we calculate tax of current year including arrear salary, excluding arrear salary. That year tax including arrear salary, excluding arrear salary, and just take the difference. That difference will be your 89 rebate. So this is in the same line. So this rebate is basically in case of the book profit, in case of the MAT, when your earlier year income due to the APPA or secondary adjustment, it is taxable in current year. So what will happen? First, calculate the current year MAT including that earlier year book like income. Current minus current year MAT excluding earlier year income, and guys, that year MAT including that income and that year MAT excluding that income. So whatever difference between A minus B and D minus C, that difference of this both amount will be your rebate under rule number 10 RB. You got my point or not? Yes. First copy down this part. Just copy down. I think you have the one blank page after the MAT. So after this metal and coronium platter case law, here it is given this rebate. I have like explain you with the help of one example. So just copy down this example. Just copy down this example. Yes, people, done. Say done. If you have completed, then just say done. Just let me check anything is pending in the volume 1 or not. Okay, done. Done, people, done. Just say done. So this was one part. If you will not read anything and just if you remember this example, that's enough. That is applicable only if the earlier year income is included in current year book profit due to the APPA or secondary adjustment. Done, Manoj Raj, done. Done. This is the mat. So this was all about your second volume. Now guys, in your first volume, first and third, everything is completed. Now directly move to the second volume. So in the second volume, you know that some part is pending in the non-resident taxation, some part is pending in the non-resident taxation, as well as there are three small topics are pending. One is the model tax convention, one is the application and interpretation of the tax treaty, and one is the base erosion and profit shifting. So basically three topics are pending, and this three topic will cover 5 to 6 marks in your examination. And guys, every time there will be a 5 to 6 mark question, last question from this topic: model tax convention, application and interpretation of the tax treaty, and base erosion and profit shifting. So in the November 2023 paper, there was question from the base erosion and profit shifting, 6 mark question. I think, yeah, 5 or 6 mark question was there. So we'll start with this topic. Mostly we will complete it by tomorrow. So now let's start with one topic. Which topic you want to study first? Let's start. All three topics are the theoretical topic. In this topic, my request, just you have to focus to the theory part or just focus to the question answer only. For the all three topic, I have included approx 10 question. So that 10 question, if you do that much question, then it will be a sufficient for you. So there is no need to worry about that. Whatever question we have included in the compiler, just if you do that question, that will be enough for your examination. So let's start with the application and interpretation of the tax treaty. That is topic number 7 from your book. So just check the topic number 7 from your book. So topic number 7 from your book. And that topic is a tax treaty, application and interpretation. Shiva. Tax treaty. Hey, what do you mean by the tax treaty? Just tell me, what do you mean by the tax treaty? Tax treaty means you can call it the DTAA, or you can call it the tax convention also, or you can call it tax treaty. All are same. So here, if you call tax treaty or DTAA or tax convention, all three words are same. So you can call it DTAA, you can call it tax convention, you can call it tax treaty. Your choice. Whatever you want to call, you can call it. Okay. Now guys, we will start with the tax treaty, that is DTAA or tax convention, application and interpretation. Application and interpretation means, suppose guys, for an example, there is a India-Mauritius treaty, and in that treaty, if there is any dispute, then how to interpret that treaty. So this topic is all about the tax treaty, application and interpretation. Interpretation means how to understand that, how to interpret that, because many times there may be possibility that one treaty is written in one language and also in the another language. There are two languages. Suppose India-China treaty, we have signed in the two languages. One is the Indian language, that is suppose English. They have signed in the English. And second language, they have signed in the Chinese language. So, and guys, suppose in the both the language, there is some difference. Then what will happen? So basically that we are going to understand in this particular topic. So application and interpretation of tax treaty. So here, all people pay attention. So first point is a source of origin of the international tax law. Now source of origin of the international tax law, it means source. Source means, if you remember the first lecture, then we have mentioned about the source of income tax law, how you will able to understand the income tax law. So guys, income tax law, to understand the income tax law, just you have to study the Income Tax Act 1961, Income Tax Rules 1962. There are various case laws, circular notification of the CBTT that you have to understand, that you have to study. So I can say that you have studied the income tax law. So for the international tax law, what are the sources of origin of the international tax law? If you wish to understand the international tax law, then how you will understand the international tax law? What are the sources of international tax law? So guys, there are three sources. One is the multinational international agreement. Now, multinational international agreement means, guys, many times what happened? Suppose more than two countries sign any agreement, that is called your multinational international agreement or multilateral international agreement. You can say that multilateral agreement. So one is the bilateral. Bilateral means two countries. Multilateral means more than two countries. So guys, in the world there are various agreements. That agreement are signed by the more than two countries. That is called your multilateral agreement. So if agreement is signed by more than two countries, it is called as the MIA, that is multilateral agreement. MIA, multilateral international agreement, multilateral or multinational you can call it. And example is a Vienna Convention of Law of Treaty, that is called VCLT. So guys, in the VCLT, Vienna Convention Law of Treaty, in the 1969, what happened in the Vienna? Vienna is one place in the Netherlands. Now in the Vienna, I think it is placed in the Netherlands only. So in the Vienna, there was one convention, and in that convention, there was 100 countries was there, I think. And that 100 countries signed one agreement, that is called your VCLT, Vienna Convention Law of Treaty. So this is called your multilateral or multinational international agreement. So to understand the international law, first you have to understand the multinational international agreement. After that, also you have to study the DTAA. DTAA means Double Taxation Avoidance Agreement, and DTAA included protocols also. Now, what are the protocols? Protocols means basically annexure of the DTAA. If there is any amendment in the DTAA, then that will be made through the protocols. So that is called protocols. Now, memorandum of understanding in DTAA. Suppose after DTAA, there is a memorandum of understanding between two countries. That also you have to study. As well as the exchange of information, how they exchange the information, etc., is forming part of the DTAA. But along with that, also you have to study the customary international law and its general practice. For example, principle of law recognized by the civilized nation in their national legal system, customary law and judicial decision, and the practices of the international organization. So guys, along with that, also you have to follow the customary international law. Customary international law means what normally happen in the last 200 years. So from last 200 years, there is an international practice, international relationship. What happened from last 2 years, that is called your customary international law and its general practices. As well as some law recognized by the civilized nation, as well as some like judicial judgment. Judicial judgment means on the international level, there are certain judgment. So on the international level, International Court of Justice gives some judgment. So that judgment also you have to study. So if you study that judgment also, then you can say that you know the international tax law. So how this international tax law, this is basically what is the source of international tax law. So I can say that source of international tax law is one is the multinational international agreement. Second is the DTAA. Third is the customary international law and its general practices. So customary international law and its general practices. So from a combined study of this three part, you will able to understand the international law. Now guys, there is one question, and I think 3-4 times they have asked this question in the examination. Like at least 2-3 times they ask only this question. Okay, what do you mean by the double taxation, and what are the connecting factor which lead to the double taxation, means why there is a double taxation. So guys, this point we already discussed in the DTAA topic. So in DTAA topic, if you remember, double taxation means on the same income there is a tax in two countries, that is called double taxation. Why there is a double taxation? Because guys, there are two rules. One is the source rule and one is your residence rule. Residence rule says that if you are a resident of any country, then that country has the sovereign right to tax your global income. That is called your residence rule. And source rule says that suppose if you are not a resident of that country, but source is located in that country, then that country can also charge the tax. That is called source rule. Now guys, if any person is a resident of one country and he is earning income from another country, then source country will charge the tax due to the source rule. Resident country will charge the tax due to the residence rule. That is called your double taxation. That is called double taxation, and we have discussed one concept, that is business in foreign country and business with foreign country. Suppose I am in India, I am recording my lecture in India, I am publishing my book in India, and just I export some books to the Nepal. I export some books to the Dubai. I export some books to the suppose some other country, Canada and all. And here guys, that is I am doing business with Nepal. Then in Nepal there is no income is taxable because I don't have the PE in the Nepal. But for an example, suppose if I have the PE in Nepal, and my business is going through that particular PE, my PE is doing this business, then income will be taxable in Nepal or not? Answer is yes, because there is a business in the foreign country. So there was a difference, business with foreign country and business in foreign country. Now guys, there are two types of the double taxation. One is the jurisdictional double taxation and one is the economic double taxation. Jurisdictional double taxation means, already we have discussed the jurisdictional double taxation. Jurisdictional double taxation means basically like we already, whatever double taxation we have discussed till now, that is called jurisdictional double taxation. Means suppose you are resident of one country, you are earning income from another country, that another country is charging tax due to the source rule and your country is charging tax due to the resident rule. That is called your jurisdictional double taxation. That is called your jurisdictional double taxation. So jurisdictional double taxation means you are a resident of one country, you are earning income from another country. So another country is charging tax due to the source rule and your country is charging tax due to the residence rule. That is called your jurisdictional double taxation. Now guys, there is a one more point, that is the economic double taxation. Now there may be a question, what do you mean by the economic double taxation? So guys, economic double taxation is very interesting. What is the economic double taxation? Try to understand. Economic double taxation means, suppose for an example, in USA, there is a one company, name is a Kim Inc. And in India, there is a one shareholder, that is suppose Mr. BB. I am the shareholder of one company, USA company, that is called, like I am a shareholder of that company, USA company. Now guys, what happens? Suppose from this particular company, I receive the dividend. Now guys, on dividend, suppose in USA, there is a concept of DDT, dividend distribution tax. Means suppose in USA, there is a concept of the DDT, dividend distribution tax. So on that dividend in USA, this company will pay the DDT. Means on that dividend, they already paid the taxes on as a DDT. Now guys, in India, you know that whatever if you receive the dividend, then you have to pay the tax in India also. Now on that dividend, I am paying tax in the India. So there is a double taxation now, because on the same component, on the same income, that is called dividend, on dividend in that country, that company pay the DDT, and in India you are paying the income tax. Component income is same now, and on income, same income, two different person paying the tax in the different country. That is called your economic double taxation. And juridical double taxation is like, you know, that single person is paying tax in the single person is paying tax in the both the country. Same person means I paid the taxes in foreign country as well as in India. That is called your jurisdictional double taxation. Means same person is paying the tax in two different countries due to the source rule and residence rule. That is called your jurisdictional double taxation. And economic double taxation means income is same, but on that income, two different person pay the taxes in two different country. That is called your economic double taxation. You got my point or not? Yes. Now guys, here in the economic double taxation and jurisdictional double taxation, sir, how to avoid this jurisdictional double taxation and economic double taxation? So always remember that this jurisdictional double taxation can be removed through the DTAA, because there are double taxation avoidance agreement, and in double taxation avoidance agreement, government will write that okay, this income will be taxable in hands of this person, this income will be taxable in hands of this country will take tax on this income, this country will take tax on this income. There are two type of the relief also. How they will give you the relief. Suppose if there is a DTAA, then they will give you relief under section 90 or 90A. There was an exemption method and tax credit method. You know that exemption method and tax credit method. And suppose there is no DTAA, then guys, resident country will give you the relief or rebate under section 91 that we already discussed under the DTAA topic. So jurisdictional double taxation can be avoided through the DTAA. But guys, what about the economic double taxation? For economic double taxation, there is no specific provision. So guys, economic double taxation may be removed. Economic double taxation may be removed through the MAP. MAP means mutual agreement procedure. Mutual agreement procedure means whenever there is a like double taxation, then one country competent authority can sit together with the another country competent authority, and they will make one arrangement, and through that arrangement they may remove the economic double taxation. So if anyone asks you that how to remove the jurisdictional double taxation, that is through the DTAA. But economic double taxation through the MAP. MAP means mutual agreement procedure. Now guys, normally DTA are of the two type. One is the like comprehensive DTA and one is the limited DTAA. One is the comprehensive DTAA and one is the limited DTAA. So just I am showing you on the income tax website. So guys, on the income tax website, there is an international taxation tab. And in international taxation tab, here, there is an international taxation. Let me check where it is given. International taxation. Oh, taxpayer service. Yeah, here it is an international taxation. There are various tax treaty. So guys, with like we are having the approx here, there is a 170 treaty. Earlier it was 100 only. Now there may be doubt why sir here it is a 170. I will explain you in the later part. So type of DTAA. If you see here na, there is a two type of the DTAA. Like if you see here on the income tax website, they have given the various type of the DTAA. But basically there is a comprehensive agreement. First is a comprehensive agreement. Second is a country by country reports that we already studied it there. One is the limited agreement. So what is the difference between the comprehensive? First, if I click on the comprehensive now, then guys, there is a comprehensive agreement with the all the countries. Like approx there is a 97 country, and with the 97 country, we are having the comprehensive agreement. Comprehensive means all the type of the income is covered here. And there are some limited agreement also. If I click on the limited agreement, then guys, we are having the limited agreement with these countries. Like there are basically 8 countries with which we are having the limited agreement only. One is with the Afghanistan, one is the Ethiopia, Iran, Lebanon, Maldives, Pakistan, and People Democratic Republic or Yemen, and Yemen Arab Republic. So here basically guys, we are having with this particular 8 country, we are having limited DTAA. Now with the Pakistan, if you see the DTAA, na, then this DTAA will get over within like only there are 6 articles. Only there are 6 article, and guys here only there are 6 article in this DTAA. There's not much article, and guys this like you know that agreement is only for the airline service, only for the air transport. So here this is agreement only for the air transport. Suppose Pakistani Airlines comes to India or Indian Airlines goes to Pakistan and all, then how their income will be taxable between India and Pakistan, how India and Pakistan will share the like right of taxation. So guys, this particular agreement is basically a limited DTAA because there is a only 6 article, and guys only they covered that is income related to the international traffic, means that is airlines income. But if we see the comprehensive agreement now, if we see the comprehensive agreement with any country, so guys there are various comprehensive agreement with 97 country. We are having the comprehensive agreement. So with Australia we are seeing the agreement. So guys, with Australia, we are having the comprehensive agreement, and we see the comprehensive agreement. It means all the income are covered here. All the incomes are covered here. There are total 27 articles. And with Pakistan, we are having only 6 articles. So with Pakistan, we are having the limited DTAA, and with the like Australia, we are having the comprehensive DTAA. So guys, I can say that there are 2 type of the DTAA. One is the limited and one is the comprehensive. So just double taxation connecting factor, start reading from here and just read till type of DTAA. Just read it. I am going to give you 2 minutes time. Done, people. Done, people. Done, people. Done. Say done. If you have completed, then just say done. Done, people. Done, 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 done. Yes, Shiva. On the next page. On the next page, here, guys, there are some directive principles set out by Article number 51 of Indian Constitution to be followed by a state in context of international agreement. So, guys, in our Constitution of India, Nidhi, in our Constitution of India, Article number 51, they have given some, some directive principles. Directive principle means you should follow this principle when you are dealing with the other countries on the international level. Whenever you are dealing, then you should follow this principle that is called your directive principle, and this directive principle are set out by the article number 51 of our Constitution of India. So our Constitution of India says that, okay, guys, whenever India do any agreement with the foreign country, or whenever we deal with the foreign country, then this four principle we have to follow. First is we will promote the international peace and security. So here our Constitution says that India endeavor to promote international peace and security. So international peace and security will be promoted by the India. That is, India is endeavor to for that. Second is India will maintain just and honorable relationship amongst the nation. Just and honorable relationship means we will have the good relationship with all the countries and we will honor our relationship. So here what this section says, that this point says that first is the India will promote the international peace and security. Second is India will maintain the just and honorable relationship amongst the nation. So just and honorable relationship means you can say that the best possible relationship we will maintain with the foreign country. So that is the just and honorable relationship among the nations. Now third is India will foster respect for international law and treaty obligation in the dealing of organized people with one another. So we will respect the international law. We will respect the international law as well as our treaty obligation. So whatever our treaty obligation, whatever our that in the international law, whatever our obligation, we will respect that. And we will fulfill that. And guys, last directive principle says that we will encourage the settlement of international dispute by the arbitration. So if there is any international dispute with India, with any foreign country, then guys, India will try to resolve that dispute through the arbitration. So through the arbitration, we are going to resolve this particular dispute. So this is the encouraged settlement of international dispute by the arbitration. So guys, what I'm saying that there are directive principle and there are four directive principle that is given by the Article 51 of the Indian Constitution. So there may be an exam question in the exam. Okay, what are the four directive principle that are given as per the Indian Constitution, Article 51? So first is international peace and security will promote. Second is maintain just and honorable relationship among the nation. Third is foster respect for the international law and treaty obligation in dealing with the organized people with another. And guys, encourage the settlement of international dispute by the arbitration. So encourage the settlement of international dispute by the arbitration. You got my point or not? Yes. Now next part. Hey guys, just tell me now, what is the need of the DTAA? If I ask you, okay, what is the need of DTAA? Can you tell me? Don't read it from here. Just tell me, what is the need of DTAA? Why DTAA is required? Just tell me. Need of tax treaty. Wherever it is written tax treaty, it means the DTAA. Double taxation avoidance agreement, or you can say that the tax convention. So tax convention is also a DTAA. So just tell me, what is the need of DTAA? Just tell me one by one. Yes sir, this is the need of DTAA. So what is the need of DTAA? Why DTAA is required? Why tax convention is required? Okay. So guys, Shiva says, okay, just tell me now, because you will answer now, otherwise this topic is theoretical topic. So first point says that Shiva says that to avoid the double taxation and tax sharing. So he has mentioned the 2 points. Okay, to avoid the double taxation, because there should not be a double taxation, as well as there's the sharing, tax sharing. Meghna says that to avoid the double taxation. Okay, like Nagappan says that to avoid the double taxation in hands of the assessee, prevention of the tax being charged twice. Oh, very good, Nihal. Agreement on which country should tax. Okay, so basically overall, like you have mentioned the 2 point from your answer. I got the two answer. One is the first is to avoid the double taxation, so that is the need of tax treaty. Second, various people are saying to share the tax. Like, okay, on this income you will charge the tax, on this income we will charge the tax, this much tax you will charge, this much tax we will charge. So this is the sharing, the that is, you can say that the allocating the taxing right. So that is written here. One more, Varsha says that to encourage the foreign trade relationship. Very good. Agreement on which, okay, to reduce the ambiguity between which country should charge the taxes and all. Oh yeah, very nice. So guys, what are the need of the DTAA? So here need of tax treaty is given. First is allocating the taxing right. Allocating the taxing right means they will allocate the taxing right. Okay, on this income, this country will charge the tax. On this income, this country will charge the tax. That is called allocating the taxing right. Second is eliminating the double taxation. It is also very simple. Eliminating the double taxation. If there is a double taxation, then just eliminate that. So first is very simple. That is the allocating the taxing right. Second is the elimination of the double taxation. Third is ensuring non-discrimination between the resident and non-resident. Guys, in the DTAA, you know that there is always one article, and that one article talk about the non-discrimination clause. In every DTAA, if you check the every DTAA, and in every DTAA, there is an article number 24. Mostly there is an article number 24. So here this is the like DTAA with the like India and okay. So just I am showing you one comprehensive agreement with Australia. So guys, in the comprehensive with the agreement with the Australia, if we see there is an article number 24, and that article number 24, mostly DTAA is having article number 24, and that article number 24 is basically related to the non-discrimination. Here article number 24A is here, because 24 here is a different article, that is method of elimination of double taxation. So they included article number 24A, that is non-discrimination article. Means under DTAA, and in this article they always mention that one country will not treat resident and non-resident, they will not discriminate the resident and non-resident. They will treat at par. So suppose India is treating the resident, then India should treat the non-resident also as a part, that is as a par. That is called non-discrimination article. As well as in the DTAA, guys, there is always exchange of information, because one country will like exchange the information with the another country, as well as the helping to other country in the recovery of the taxes. Helping the other country in the recovery of the taxes. Suppose one person fly from India and he has not paid the taxes in India, and now he is in UK. And suppose India and UK is having the agreement, and through that agreement, in that agreement, suppose if it is written that India and UK will help each other in the recovering the taxes, then UK will help the India in recovering the taxes. You got my point or not? Yes. So what this particular point says that what are the need of the tax treaty? One is the allocating the taxing right. Second is the elimination of the double taxation. Third is basically ensuring non-discrimination between the resident and non-resident. Fourth is resolving the dispute arising on account of different interpretation of the tax treaty. So suppose if any dispute is arise on account of the different interpretation of tax treaty, then it will be resolved through the tax treaty only. Next is providing assistance in the collection of fair and legitimate share of the tax. So here one country which one country will provide the assistance to the another country to recover the taxes. And guys, along with that, there are some other additional need also. Further, in addition to the above, there are some other principles which must be considered by the countries in their tax system. One is the equity and fairness. Now, what is the equity and fairness? Equity and fairness says that the same income earned by different taxpayer must be taxed at the same rate regardless of the source of the income. Regardless of the source of income means there should be a equity and fairness. Now, equity in Hindi we call it equity means samta, like samanata. Equity means samanata, and fairness means samrupta in the Hindi. So like samanta and samrupta, there should be a equity and fairness in the tax system. Means suppose for an example, there is a one type of the income, then everyone should pay the tax at that rate only. Suppose there is a long-term capital gain. So on long-term capital gain, like 20% is tax rate, then for resident also it is 20%, for the non-resident also it is 20%. That is called your equity and fairness. Now guys, there is a one more point, that is neutrality and efficiency. So in your tax law, there should be a neutrality and efficiency. And guys, there are two types of the neutrality. One is the capital export neutrality and one is the capital import neutrality. Now what is the capital export neutrality and what is the capital import neutrality? So neutrality says that your business decision will not change due to the tax law. Your business decision will not change due to the tax law. That is called your neutrality. So your business decision will not change due to the tax law. Means for an example, there is a one person from India. That person, suppose doing business in India, or suppose that person want to do business in UK, then his business decision will not change due to the tax law of the UK. That is called your neutrality, and it is called your capital export neutrality, because you are exporting the capital now. So here, for an example, there is a one person in India. That person wants to do business in UK, and instead of India, he is doing business in UK. So his business decision is not going to change due to the tax law of the India and UK. So that is called your capital export neutrality. One is the capital import neutrality. Capital import neutrality means, suppose for an example, like we think from the Indian perspective, then suppose a person of the UK, that person is investing in India. So in India, whatever tax are charged by Indian authority will not discriminate that non-resident person and resident person. That is called your capital import neutrality. So if any person is doing business in India and that person is non-resident, then our government will not discriminate like that non-resident and resident, means they will not charge the unfair tax from the non-resident. That is called your capital import neutrality. As well as guys, what is the need of DTAA? DTAA need is to promote the mutual economic relationship, trade and investment. Promotion of the mutual economic relationship, trade and investment, guys, with the Mauritius. We have the agreement, and that is for to increase the investment. So here clearly mentioned that we will increase the investment from one country to another country. So that is for mutual economic relationship, trade and investment. That is also like need of the DTAA. So here neutrality, I am reading from here, neutrality and efficiency. So neutrality factor provide that economic process should not be affected by the external factor such as the taxation. Neutrality is twofold. One is the capital export neutrality, one is the capital import neutrality. So here capital export neutrality provide that business decision must not be affected by the tax factor between the country of resident and the target country. Example, Mr. Devam, resident of India, wants to invest in the business of country X. Then his business decision must not be affected due to the taxation. So his business decision will not affect due to the taxation. And what is the capital import neutrality? Capital import neutrality provide that the level of tax imposed on the non-resident as well as the resident must be the similar. Suppose Mr. Sam, resident of country X, doing business in India, then tax imposed on Mr. Sam and the Indian resident person must be the similar. So this is your need of tax treaty. Now guys, we will take the break, and after break we will start with the interpretation of the tax treaty, means how tax treaty will be interpreted. But guys, here some like question you must try from your compiler. So I'm just giving you some question from your compiler. Just check 1-2 question. So here this topic is application interpretation of the treaty. Application and interpretation of the tax treaty. Now question number 1 is related to the what do you mean by double taxation and what are the connecting factor. That first point we have discussed, economic double taxation, juridical double taxation. This is your question number 1. You will read in the break. Now second is need of treaty, that just we have discussed that need of treaty. Then there is a non-discrimination as well as the like neutrality and efficiency, equity and fairness, promotion of mutual economic. So you can do this. Okay, so question number 1, question number 2, question number 3, 4 will discuss later. Question number 5 will discuss later. 6 will discuss later. Question number 7 first part, that is same. Okay, like question number 7 first part. Yeah, explain briefly juridical double taxation and economic double taxation and how the tax law provide the remedies. So juridical double taxation will be avoided through the DTAA, and economic double taxation can be avoided through the mutual agreement procedure. So this first part you can do that. After that, question number 8 also you can do that. Okay, what are the approach for elimination of double taxation in the model convention? Under model convention we will discuss that topic, model tax convention, but under model tax convention they have mentioned that how double taxation can be avoided through the two method. One is the exemption method and one is the tax credit method. One is the tax exemption method, one is the tax credit method. Now explain the meaning of the juridical double taxation, economic double taxation, and can the problem of economic double taxation be solved by the above approaches? So guys, here economic double taxation problem can be solved only through the mutual agreement procedure, not through any other means. Okay, so this question also you can do in the break, you can check in the break, question number 8. After that, question number 9, what are the meaning, two type of the DTAA? One is the limited DTAA and one is the comprehensive DTAA. Limited DTAA example is with Pakistan. We have the DTAA and only airlines, international air transport is covered in India, Pakistan DTAA, and with other country we are having the comprehensive DTAA. So you can check the question number 9 also, very simple, December 21 exam question. Question number 8, July 2021 exam question. After that, question number 7, part number 1 you can do. After that you can do the question number 1 and 2. Okay, so I think 50-60% question we already did. So just check it and take your break for 10 minutes, and after 10 minutes we will start with the next part. Okay, so just take a break for 10 minutes, okay? And just check this question, just check it.